The company that I want to present today is, I think, a good illustration of my investment approach. It is called Barratt Developments, and it's the largest UK house builder. This is a stock I've been following for years. I owned it in 2004, 2005, then sold it too early, before it peaked in early 2007. At the time, just after a new CEO had been appointed and the stock was fully priced, the company made a successful bid for a rival, Wilson Bowden, paying £2.2 billion. It was about 2 times NAV. This was the largest takeover in the construction sector. Barratt paid £2.6 per share at a 23% premium on the last price and a 60% premium on the July price when the company put itself up for sale. This was Barratt's only second takeover in 26 years. It increased sales by 1/3 to 20,000 homes, to roughly 12% of the market, and increased the gap versus Persimmon, which at the time sold 17,000 homes. And Persimmon had already just recently bought another smaller competitor called Westbury a year earlier for 1.4 times NAV. Barratt's revenues increased by 50% to 3.6 billion. Now, house prices had gone up 10% that year. Market cap was 3.1 billion, and the stock was up 35% in the last 6 months. So you can imagine this was a typical consolidation game. The idea was that 3 or 4 players will be left. The acquisition gave access to all markets, to land. It was a powerhouse for growth. It was an excellent fit. Value accretion would be immediate. There were estimates of 45 to 50 million savings. The company would go into the FTSE 100, synergies, combined strength, and so on and so forth. Interestingly, 2 competitors, H. Bose and Wimpey, had gone out of the race to buy the company. Now, as it turned out, this was a typical acquisition at peak cycle. Soon after, the residential property market started to deteriorate sharply, both in price and volume. Mortgage applications collapsed about 70% as banks were trying to repair their balance sheet. As sales went down, the company increased debt to finance activity. Now, the stock price had already collapsed in 2007, and the decline continued in 2008. I bought the stock again on the way down in early 2008 and tripled position in July of that year. Unusually, this was great timing as the price doubled by the end of August. But then Lehman happened and, as we know, changed everything. The price went right back down. At the time, Barratt had book value per share of about £5 and tangible book value per share, once you strip out the goodwill of the acquisition, of about 3.5. But at the end of November 2008, it was trading at less than 50 pence. Now, going back to what I was saying before, what was the probability at the time that this was the right price? Of course, with hindsight, we can say that the whole world was massively undervalued at the time, but as you well remember, that was certainly not the consensus view. In particular, regarding Barratt, the market was very concerned about the debt, the breach of covenants, and the dreadful state of the housing sector. The market made the mistake to take the 50 pence price as a given and to look for conditions that would restore the health of the sector, conditions that appeared at the time extremely remote. On that basis, the market, or Mr. Market, justified the price. Brokerage reports written at the time are a good read. I still keep them. Moreover, this view was held with brash overconfidence. Typical comment was, Barratt is going bust. I wouldn't touch the stock, I wouldn't touch the sector, and so on and so forth. And there was also a powerful display of confirmation bias, as there was, in fact, plenty of evidence that the price was far too low to justify any realistic concern, but that evidence was completely disregarded. It was on that wall of worry that the price climbed back above 2, and in 2009 up 170%. In July of that year, in 2009, a new CFO was appointed, and a rights issue was called in November. The issue of new capital dissipated the debt worries, but 2010 was still a negative year for the stock. It was down 29%, as the skepticism on the housing recovery still dominated the scene. It was a tough test for one of value investors' capital virtues, patience. And so was 2011, with the stock barely budging and ending the year well below £1. However, this year patience has been finally rewarded. The stock is now at £1.7, up 80% since the beginning of the year. But the reason I'm talking about it now is not for gloating, but because I believe it is still very undervalued. The case is pretty straightforward. The company has been producing double-digit EBIT margins for many years. In the slides you will see, I show data back to 2003, but it's the same picture going back further. Margins collapsed to 1.3% in 2008, but since then there has been a steady recovery, which has some more way to go. Over the last 4 years, in particular, the company has been buying land at cheap prices, typically 40 to 50% lower. And profitability is therefore being restored even at stable house prices. More than half of the homes that Barratt sold this year has been built on land bought after 2008, thus ensuring restored profitability as the market recovers. And recover it will, as demographics clearly play in its favor. There has been an increasing gap between household formation, which runs about 250,000 per year, and house construction, which is currently 120,000, which is bound to be reabsorbed. Moreover, in the UK, regulation restricts supply. Return on capital has had a similar recovery. Most of the company's assets consist of what they call inventory, which is land under development and work in progress. The rest is basically the goodwill of the Wilson Bowden acquisition. Again, return on capital has been steadily returning to double digits. The company book value per share is currently around 3 and 2.2 if you strip intangibles. At £1.7, there is still more than a 40% discount on book versus a historical 40% premium. Moreover, I calculate normalized EPS at 40 pence. Currently it's only 7 pence. And I don't see why this company should not be at least at 10 times earnings. So in both ways, I converge towards a full valuation of around £4, which is still a long way to go.